Hi guys, can you hear me all properly? Sure. So, as pointed out, I'm Ashish. I'm from Nishith Desai Associates. To give you a 1-minute brief about what we do, we are an international law firm with offices in the US, a couple of them, one in New York, the other in Silicon Valley, a couple of offices in Mumbai, here at Nariman Point and at BKC, in Bangalore, Delhi, and Germany. For startups, we are strategic advisors, and along with that, we provide legal and tax advice to externalize or globalize your business. We'll tell you what needs to be done, how it needs to be done. I think in the previous session, we discussed why we need to globalize, right? I think I'll discuss how you need to globalize. What are the important factors you need to consider before you start globalizing? I'll keep the PPT short. It's not a long PPT. We'll discuss the PPT for about 15 minutes. Then I think let's do some Q&A. I think you'll all have some questions on how we can globalize from a legal and tax perspective, right? Perfect. So I think, how do you globalize, right? And this is more of a why do you globalize, but we'll just quickly go through it. The objectives behind globalization, right? That become very important. How people have started thinking about globalization is it going to give me a tax benefit? No, today you don't think from a tax perspective only. The world that we are living in is not the world that was there 10 years ago. Today, the world thinks about substance rather than form. So what are the substance that you have when you globalize your business? Is there a market you're looking at when you want to globalize your business? These are the solid considerations that need to be taken into account before you start thinking about globalization, right? So what happens when you globalize? You have a global holdco, you consolidate your value, you move to a IP-friendly jurisdictions because with startups, IP becomes very, very relevant, right? All of these considerations need to be thought through. Some other considerations that we keep in mind are, if you want to list, offshore listing is far simpler than listing in India. You cannot list your Indian company abroad. There are some Companies Act rules that prohibit you from doing that. There are exchange control restrictions in India which don't allow you to take money outside India, whereas in most foreign jurisdictions there is no exchange control. Therefore, you can repatriate money very conveniently outside India. There is efficient administration, which I think India is also growing into. So corporate governance, etc., is, while prevalent in India quite strongly, the foreign countries also provide a very efficient administration system. And of course, bilateral investment treaty protection. I think the whole Vodafone saga, where they are today, it's the bilateral investment treaty that is actually helping them fight that battle with the Indian government, right? And last but not least, there is, of course, the tax costs that are very, very relevant to each one of us, right? I mean, you don't want to end up paying tax about 42% in India, and therefore tax becomes definitely important. So I think some of the most standard ways in which you can globalize your business, I've tried to put out a couple of them here. The first one is a simple transfer of shares. The second is a transfer of the business of the Indian entity. And the third is a standard asset purchase agreement. Now let's take each one of them and how you would want to do this. To globalize your business, first you need to have a company offshore, right? You'd set up an offshore company. We'll come to the regulatory and the tax reasons and prohibitions for each one of them. But you'll set up a global company outside India. That global company could then directly purchase shares from the shareholders of the Indian entity, of the startup, and thereby creating that India Co behind, below the global holdco, right? That's a standard acquisition of shares. Now, certain issues with an acquisition of shares, if your Indian company today is valued significantly, then the value of your shares are also going to be significant. You may have incorporated that India company with 1 lakh rupees, but the value today is, let's assume, 1 crore. So the remaining 99 becomes subject to capital gains tax in India. For capital gains tax in India, the rates for an Indian resident is 20%, which can go up to 25 to 28% in case of an Indian resident, and in case of short term, which means if you have held shares for less than 24 months, the rate could go up to 30% plus surcharge and cess, that could go up to 37%. So these become very, very important considerations when you are undertaking a transfer of shares, right? There are some other considerations with respect to how and why how you can set up the global holdco, because as I said, there are certain regulatory considerations and prohibitions that the RBI has put up by way of the Foreign Exchange Management Act that need to be looked into before you can straight away go and set up a global holdco, right? We'll discuss that in a minute. I think I'll just go through all the three structures, and then we can discuss how and why and what is the issue with setting up a global holdco. The second option is a standard business transfer. What happens in a business transfer? You again set up the global holdco. The global holdco sets up the Indian company. Now, instead of doing a transfer of shares, you acquire the business as a going concern into the new India Co. Now, what do you mean by as a going concern? That means all the assets and liabilities of your current startup will move as is into the new company, so that the next day after the transfer takes place, you can keep running the business as you were running it, right? The tax considerations for a slum sale are simply that you look at the net worth of the current startup, and that is the amount of money that you will need to pay to buy the business. So therefore, a slum sale may make more sense as opposed to a transfer of shares, because your capital gains may not be that high, even though the rate is going to be similar. The third option is an asset purchase, which is absolutely similar to a transfer of business. The only difference being that instead of transferring the whole business as a going concern, you'd only choose the assets that you want to move. It's not the most popular option that people choose, but in certain circumstances, when you do not want a part of the assets, you may choose to go with an asset purchase, right? Now, coming to the regulatory issue around setting up a global company. As resident Indians and resident shareholders, when you want to remit money outside India, there are a number of restrictions and considerations that become very, very important. The first one being round tripping. What is round tripping? When you as an Indian resident who has earned money in India send money outside India, which is indirectly then going to come back into India, that is what round tripping is. Round tripping is not defined anywhere, but it is frowned upon by the Reserve Bank, and the Reserve Bank has in the past unwound transactions because there is round tripping involved there. So what exactly does round tripping mean? Where the shareholders set up the global holdco, they send out money under the liberalized remittance scheme, wherein you can send out about $250,000 per year per shareholder. So if you are 3 shareholders, you could send out about $750,000 per financial year. Once the money goes out, you set up the global holdco, you capitalize the global holdco with the money you sent out. Then as soon as you want to set up the India Co, that money will automatically come down, right? Because you'd want to capitalize the India Co. That's where your business is, that's where you want to work in, correct? And at that point in time, that money, when it comes back into India, is round tripping. And that becomes a very, very significant consideration before you want to globalize your business, right? It's common to all of these 3 structures. We can think about how we can get out of round tripping. One of the most common methods that people tend to use is that if some of you have been non-resident Indians and have earned money abroad, the money that you have earned abroad can be used to set up the global holdco, and then that money can be used to capitalize the new India company that you are setting up. This does not result in round tripping because the money was never Indian. It was the foreign money that you are using to set up the offshore. There are other structures as well, but we could discuss that maybe later. They're more fact-based. Right. I have laid down some considerations that become very important when you want to globalize. From an Indian exchange control perspective, like I said, there's round tripping. There is foreign direct investment, whether the investment you are making into your new India Co, whether that itself is 100% automatic, or do you need to go to the RBI to take permission before you can even invest into the Indian company. Pricing guidelines, especially in the case of a transfer of shares, become very relevant because as an Indian resident, the Reserve Bank says you need to have a fair market value, and the price that the non-resident entity shareholder company is going to give you cannot be lower than that fair market value. So it always needs to be higher. There is a floor that has been set up and you need to pay above the floor price. The liberalized remittance scheme, I spoke about it, 250K USD that you can send out every year per individual, per financial year, and the overseas direct investment. Under the overseas direct investment, instead of an individual, you set up a company. That company helps you set up the global holdco outside India. The amount of money that an Indian entity can send outside India is far more. It's 400% of your net worth. So if the net worth is about 1 crore of the Indian company, you can send out 4 crores outside India to set up the global holdco. From a tax perspective, which I think becomes really significant, is the capital gains tax that as Indian resident shareholders you need to pay. The rate is 22 and 30% exclusive of surcharge and cess. So we need to look at and think about how we can mitigate capital gains tax. To be very honest, as Indian residents, mitigating capital gains tax is very, very difficult. We can try and reduce it to the extent possible by trying out different structuring methods. One of them, like I mentioned, was the transfer of business. The next is withholding tax. This becomes relevant only when you are paying money to a non-resident. Generally, payments to a resident are not subject to withholding tax. Of course, there are exceptions to it. The next couple of things, the poem and the GAR. Now, when you want to globalize your business, right, you guys will still want to be sitting here in India and operating your business. Therefore, who is going to manage and undertake the operations of that global company outside India? Will you leave it a shell company? And if you leave it a shell company, how does that work out? In the current context, both poem and GAR are interlinked. If you have a foreign company which is not doing any business, which does not have employees, it's basically a shell company which has some office in an administrator's office. Board resolutions are just being passed. There is no discussion. There is no investment that is being made. The risk of GAR kicks in, which means that you set up that global entity with the main purpose of tax avoidance. The main reason why you needed to set up that entity was to take some tax benefits outside India. That's when the Indian tax department will get up and say that, you know what, I don't consider this entity at all. And whatever you have done, whatever tax benefits you are trying to take will not be given to you. I will recharacterize all this as Indian income and will have to be taxed in India. So very significant and very important to keep in mind that before we globalize, we think about all the considerations, all the non-tax reasons why we should globalize our business. And there could be many if you think about it, right? The first one being, is your customer base outside India? If it is, that's a significant reason why you'd want to globalize your business. And there are many others that could follow. The second is poem. Now, poem is not so poetic, like my mentor says it. Poem means if you are sitting in India and taking decisions for the foreign entity that you have set up, then that foreign entity will be considered to be an Indian resident. And when that happens, all income of that foreign entity will be subject to tax in India at the rate of 40%. So we need to make sure how we mitigate poem. Some of the ways are that you conduct all board meetings outside. There are no Indian resident on the board of the foreign company. The payments, there are payments that are made from the foreign entity made to its employees. There are some ways where we can mitigate poem. But the directors, Indian directors sitting on boards outside India can result in a significant poem risk. The others are transfer pricing and GST. I think these need to be considered. Transfer pricing needs to be considered when you are making any payments between related parties. Basically, once you set up your global business, if there are any payments being made between the foreign entity and the Indian entity, they need to be transfer priced. Basically, the payment needs to be at an arm's length. GST, I think we've heard enough about GST in the last couple of years, so I'll skip that. Some other considerations, the choice of jurisdictions, we'll just discuss that in the next couple of slides, which jurisdiction you can think of. The choice of entity in that jurisdictions, whether you want a partnership or a company or maybe some other type of entity that exists in one of those countries. The instrument through which you want to make your investments in. Labor law compliances in that foreign country, corporate governance and administrative issues. Right. So I have just put down 4 countries and some very basic details about these 4 countries where you may want to set up your foreign business. The first one is Singapore, ranked number 2 in ease of doing business, which is a very, very important consideration when you want to go outside India, simply because when you are wanting to do business, I think your concentration should be on doing business rather than on administrative and tax issues that will keep you not doing your business. There is a territorial tax system. That means there's no taxation of non-Singapore income, which is not remitted back to Singapore, which simply means that if a Singapore entity has an Indian subsidiary and the Indian subsidiary made some profits, that will not be taxed in Singapore merely because the Indian entity made some profits. The corporate tax rate is 17%. There is no capital gains. There is exemption for inbound dividend. That means any dividend paid by the Indian entity to the Singapore entity will not be taxed in Singapore. There is no withholding tax on outbound dividends. That means that shareholders, when you receive money from the Singapore entity, you will only pay tax in India as per your normal personal income tax. There will be no tax in Singapore at the time when the payment is made. Number of tax treaties, special in tax incentives to IP and research and development, no thin capitalization, which simply means even if you want to do a debt funding, there are no restrictions with respect to Singapore on receiving interest, which could be in many other countries, including India. Next is Mauritius, I think very, very popular. Effective corporate tax rate of 3%. Now, how that is achieved, the rate is actually 15%, but you get a deemed credit of 80%, which makes the corporate tax rate to as low as 3%. Similar to Singapore, no capital gains tax, exemption, no withholding tax on outbound dividends, 15% on interest and royalties. Number of tax treaties, no exchange control, no thin capitalization of CSC rules. A couple of important points about Singapore and Mauritius which have become relevant after 2017. The treaty that India had with Singapore and Mauritius was amended by a protocol. The earlier treaty said that when a Singapore resident sold shares of an Indian company, the Singapore entity or the Mauritius entity or the country Singapore or Mauritius had the right to tax these gains, right? So when an investor invested money from Singapore into an Indian company, and when he sold those shares, if those shares were purchased prior to 2017, March 31st, then there was no tax at all on the gain that the investor made on the sale of the shares. That has changed. India has got the right to tax now. So any shares bought after 1st April 2017 and any sale made of those shares will be taxed in India at the corporate tax rate, at the capital gains tax rate in India. Similar for both countries, Mauritius and Singapore. So we need to be mindful about doing something from there if we are thinking of a tax consideration. The next is Netherlands. It's an upcoming popular jurisdiction. Tax rate is quite high of 25%, but tax deduction for interest on loans to acquire subsidiaries is given, which helps you take a loan, set up the subsidiary, reduce your profits. Dividend exemption is available, which means if you receive dividends, you don't need to pay tax in Netherlands because tax is paid in India. There is capital gains rising on disposal of shares are exempt when the shares are part of a holding of at least 5%, which normally would be the case because your Netherlands entity would generally hold 100% of the Indian entity. Domestic rate of withholding tax applied on dividends is 15%. Since it's a withholding tax, you will get a credit of it when you receive it. So in India, when you receive dividends, you ought to pay approximately 30% tax, 15% of which would already be paid by Netherlands. So you would only end up paying 15% in India. Various IP benefits are also provided in Netherlands. Last is United States. Well, United States has currently become a very popular jurisdiction because of the tax rate that it is now providing to the investors, to the companies, which has gone down as low as 21%. Earlier, this was about 40%, plus there were state and city taxes also applicable, which are still applicable, but the base rate is only 21%. Dividend exemption is available on dividends with shareholding of at least 10%. Again, this would apply to almost everybody here because the US entity would hold the Indian entity 100%. There is withholding tax applicable at the highest rate of 30%, almost similar to India. The United States does not index the tax basis of assets for purpose of determining the amount of gain or loss realized upon a disposition, which means you would normally account for inflation, account for the price at which you paid when you bought the shares. Those are discounted. IP amortization is deductible. One important point with respect to the tax rate in US is that while the tax rate seems 21% plus only the city and federal, remember at the time of taking credit for the taxes you have paid in India, the taxes that you've paid in India and you want to take a credit of that in the US, you will only be allowed to take credit of the 21%. The city and state taxes are not creditable. That is an important consideration that people tend to forget when they choose US as a jurisdiction. So I think this is all about my slide. Happy to have questions, happy to listen from you guys, what you guys have done, what you feel as challenges from a legal and tax perspective. Sure.
Honest question, at what point of time for startups can be offered you? Series B, Series B?
I think if you come and approach us, we provide not only legal and tax advice, even strategic advice. And with our experience with startups, I'm sure we can work something out. Yes, please. Right. That's right. No, so you would normally, in the US, you would normally go to Delaware, where you set up your entity. It has got very easy corporate laws also. You would normally not set up your entity in any other state. Correct. So your place of incorporation could be Delaware, and you could do your business from any other state. That's perfectly okay.
Typically, companies have set up business in India over the last couple of years, and they have some business already in place.
Right.
Now, if you want to set up, say, global holdco,
Right.
the first slide what you showed, from a tax point of view of Indian shareholders, I believe the second one, which is kind of a transfer of business,
Correct.
would be
Correct.
the best way to
Absolutely. I
do
think
that.
Sure.
But how still the round tripping
Right.
impact can still hit
Absolutely.
you. So how does one look at either you mirror the shareholding of Indian shareholders into the global holdco? How do you?
Sure.
I know you can't be specific, but a broad
No,
guideline.
sure. So I think I'll tell you what. Even when you said about mirroring of shareholding, right? Your mirroring of shareholding cannot happen without money going outside India. So while you want to mirror your shareholding into the global co,
That can be at a basic $1 kind of.
sure. But the way we have seen this work, even if you have sent $1 out, RBI does not see that only that $1 is going to come back into India. They look at it as a transaction, there is round tripping happening, and therefore unwind the structure. So normally what we would suggest in situations such as this is, first, the investment you are making, like you pointed out, has to be absolutely nominal at the global holdco level. The second, before you get funding from an investor at the global holdco level, how about you take the money you receive from the shareholders, the capitalization amount, you make an FD and you keep it aside, right? You make a couple of bank accounts. So the first bank account where you receive your money and you kept it. At least you will have some ground to tell RBI that, you know what, even though I received this money, I have never brought this back to India, right? That are some things that we can consider when setting up a global holdco.
What about the investment you make in setting up the global?
Right. Great question. So I think that becomes very, very important, and that is a question that needs to be that every startup needs to ask itself, right? At what point in time do I need to globalize? Because the cost of running this structure, apart from setting it up, is also quite high. We normally envisage about $8,000 to $10,000 every year to be spent on just maintaining a structure like this. And this is when I'm talking about only one entity being a subsidiary. If there are multiple, there could be multiple. I mean, there could be this figure could change, and that is something that needs to be considered depending upon what your gross revenue you think is going to be.
No, so I'm not asking where the money will come from.
Sure.
I'm saying, so if you have an Indian company and if you've got the funding here, and you want to use some of that money to set up a global holding
Sure.
company, then what happens?
No, so if you were going to use that money, you would only have to send it out through an overseas direct investment, which would mean that your global holdco will not actually be a global holdco, but will become a subsidiary of the Indian company. So therefore, at that point in time, if you are really wanting to globalize, we need to think of a method where your investor at the Indian company becomes your investor at the global holdco level. So basically, whether we should give him an exit at the India level and then retake his money at the global holdco level, or is there any other way of mirroring his shareholding at the global holdco level while not allowing him to pay taxes in India? I think that becomes very relevant, especially in a Series B or Series C when the Indian entity has received all of that. Yes, please.
Can you talk about inversion, where there is subsidiary which actually set up that Indian company?
Sure. You won't have something else to add?
No.
All right, perfect. So in a situation where we talk about inversion, which would go under the overseas direct investment route, right, where your net worth of your Indian company, you would be allowed to send out 400% of your net worth outside India. Now, in that situation, it becomes quite the reverse. Your India co would normally become the global holdco, and you would have subsidiaries all over the world. So if we are to take, let's assume, US to be your subsidiary, where you set up a subsidiary, right? The Indian company would send money outside India, and the global, the subsidiary in the US would be set up. Now, in a situation like this, where India is the global entity, the value is consolidated at the India level. The problems or the issues that we see with a structure like this is that your IP also would normally be residing at the global holdco level, which would be India, because that's the way you would want to attract your investors to come and invest, right? Now, when somebody wants to invest in India, the exits are also that heavy to, the exits are also that costly, because with India, you would normally end up paying taxes of capital gains for the investors in India. So when they want to exit, they'll have to sell the Indian company shares. Rarely do we see that investors are okay with investing at the subsidiary level offshore. Sure.
And in that inversion case,
Right.
in inversion case, what are the scenarios for taxes and all the subsidiaries around the world? And it's the same or it's changed there as well?
So the taxes would generally remain the same, but it would also depend upon how much profits you are earning at the subsidiary outside India. Now let's assume a situation where your subsidiary was having multiple contracts with the customers outside India, which would mean the revenue would be generated at the subsidiary level, and therefore the tax rate at the subsidiary level would be chargeable, which would be 15% in case of Mauritius, 17% in Singapore, 21% in US. Does that answer your question, or?
Yeah. So it's you can say, yeah.
Right. That's it, I think. Anybody else? Sure. Correct. Sure. I think I said it, I'll repeat it. 1st April 2017 was the day when the... No, you're talking about perhaps the multilateral MLI, the multilateral investment. So, all right, the MLI is going to change not just Mauritius and Singapore, but almost all treaties around the world. Not just that India has signed up with them, but even other countries that have signed up with India. Or with other countries with other countries. Now, the MLI is a higher threshold when you want to restructure your business, if I put it that way, because it says that your main purpose of doing this structuring, I mean, let me put it this way. The Income Tax Act provides that your main purpose has to be tax benefit, right? Only then will you be subjected to GAR provisions, which would allow the Income Tax Department to unwind your business or say that everything is taxable in India. The MLI goes one step ahead. It says if one of your principal purposes was tax, then the treaty benefits will not be available to you. You are setting up this entity only for the purposes of taking tax benefits, and therefore you will be taxed in the country in which you are residing in, which would be India. Now, when you say one of the principal purposes is tax, it becomes a very, very narrow threshold to go to, because normally one of your principal purposes will be tax. It will never be that you are setting up a global holdco in a jurisdiction with high tax as 40%, right?
So we now have time for just one last question.
Sure. Done, I think. Sure. Thank you. Thank you, everybody.
Thank you. So on behalf of Kai, I would like to thank Ashish and give him a small gift of appreciation.
Sorry? Sure.
I can just ask him, so in your opinion, which would be the best places identifiable based on their regulation, which you would suggest in the diagrams of the top 5 countries where you would set up a global holdco to benefit you as a...
Sure. So I think the answer to that question is not really objective. Like I said, you'd want to look at many other considerations, including where your business is going to grow, what you're going to do from that entity, and not just tax benefits in that entity. But if I were to look at any countries that I would say that you could set up a global holdco are, it would be the Singapore, the Netherlands, the United States, last Mauritius, but we need to think about Mauritius more strongly as to what is the reason for you to set up a Mauritius entity.
Thank you so much.
Thank you.
Okay. Thanks, Ashish.
Thank you.
And on behalf of Kai, I would like to give you a small token of appreciation.
Sure. Thank you so much.